So now if we have a characterization for the return of a stock and the expected return of a stock using the single factor model, what we can actually do is perform a risk decomposition. In other words, we can actually use this idea that the risk of all stocks, or more broadly all risky assets, is driven by two things: their exposure to a common macro risk factor, and the rest being driven by sort of idiosyncratic asset-specific noise. We can then decompose the variance of any risk asset into two components: the systematic and the firm-specific. Now, how do we do this? Well, we can actually say that the standard deviation of any individual asset is going to be, remember, the beta times the standard deviation of the market, because, or the macro factor, because that's where our systematic risk comes from. The rest, of course, is going to be the standard deviation of the firm-specific risk. If we square these two terms, then we get the variance. And importantly, we assume that the firm-specific risk is uncorrelated with the macro risk, mostly by definition. If something happens within the firm, the CEO leaves, the firm develops a patent, it conducts M&A successfully or unsuccessfully, there's a scandal, or there's a series of successful hires, in other words, good news or bad news, at the firm level shouldn't be correlated with the macro environment. So if there's no correlation term between firm-specific risk and the standard deviation or variance of the macro factor, then we don't have a covariance term between these two, and these two terms then are all it takes to express the variance of any individual risky asset. And another way to think about it is we can actually write down the formula for variance. We can actually say that the variance is going to be the expected value of the return to the asset minus the expected return to the asset. Square. So in other words, the expected value of squared deviations from the mean. And given those two formulas that we derived just a bit ago, the regression model for the return of the asset as alpha plus beta times the return to the risk factor plus the epsilon error that represents firm-specific risk, and the expression for the expected return to the asset, which is just alpha plus beta times the expected return to the macro risk factor. If we literally substitute those two in, we can cancel the alphas, and then we actually can complete the square with the cross product term dropping out, because there is no correlation between the macro factor and the firm-specific risk. And that is a way that we can actually derive this formula. And analogously, if we remember our formula for variance, we also remember our formula for covariance. We can use it to derive what the covariance of any two risky assets are in terms of their exposures to the macroeconomic risk factor. In the single index model, most commonly used, their exposures to the market. Remember, the covariance between two risky assets, let's say I and J, is going to be the expected value of the return on asset I minus the expected return on asset I times, and I suppose I should make this clearer that we're taking the expectation of this product, the return to asset J minus the expected return to asset J. So we can again use those two formulas that we derived for the returns to asset I and J, alpha plus beta of I or beta of J times the return to the macro factor plus the error term for I, epsilon I, or the error term for epsilon J, and the expected returns to assets I and J, which is to say alpha plus beta times the expected return to the macro risk factor for either I or J. And if we substitute those two formulas in for both the returns and the expected returns for I and for J and multiply together, again sort of acknowledging to ourselves that the firm-specific errors are going to be uncorrelated. In other words, the firm-specific error for I times the firm-specific error for J. If we take the expectation of that, by definition that should be 0, right? Because anything that is specific to either firm is going to be unrelated to anything that is going on at the counterpart. Well, that means that the firm-specific part goes away, and really all that remains then is just the exposure of each firm to the macro risk factor, which is to say beta I times beta J times the variance of the macro factor, sigma m squared. So the covariance is really just the product of betas times the market index risk. Now finally, the correlation is essentially going to be the product of the correlations with the market index. And of course what we can do is we can literally just take our formula that we previously derived for covariance up here. And remember that the correlation is covariance divided by the two standard deviations, so we can, using our formula for covariance between assets I and J, we can actually derive the correlation between I and J by just dividing by the two standard deviations here. And we can see that that is the same thing as the product of correlations with the market, because this term is the correlation with the market for asset I. Here's the covariance of asset I with the market. And here are the two standard deviations of asset I and the market. Therefore, this term is the covariance of asset I and the market. And this term here, including the sigma j, that's the covariance of asset j with the market. Sorry, the correlation of asset j with the market, because the numerator is the covariance term, and the denominator are the two standard deviations of asset j in the market. So that means that we can actually express those three critical risk measures, the variance, the correlation, and the covariance, for any two risky assets in terms of just their exposure to the single macro factor. And if you think about it, that's way simpler than estimating a complex variance-covariance matrix with a multitude of entries, right? It means that really now all we need is just betas. So how about portfolios? Well, if we have a portfolio of assets, well, just as any asset under the single index model has two components, it's got the firm-specific error and the sort of macro risk noise. What's the firm-specific component like in a portfolio? Well, we can actually write out what the variance is going to be. The firm-specific variance of the portfolio is going to be added up across all of the risky assets in our portfolio. What's the weight on each of these assets? Well, if we're equally weighted, the weight is 1 over n. For variance, we can take the weight out if we square it. So let's say we do. And the variance of each of the firm-specific components of each of the individual assets is, of course, just variance of epsilon I. Now remember, there's no covariance terms here for us to worry about because by definition, the firm-specific components are not correlated across firms. So really then all we have is 1 over n times the variance of all of the individual firm-specific components. Or I guess one other way to think about it is the average variance of the firm-specific components. Because essentially we can divide or split the 1 over n square into two parts. We can have 1 over n, and if we get rid of the exponent and instead just divide by n, then we can just call this term the sum of, if we move the 1 over n to the outside of the sum of each individual variance of the firm-specific risk component divided by the number of terms. Well, that's actually just the average variance of the firm-specific component for all of the firms in our portfolio. So in other words, we're saying that 1 over n times the sum across all assets n of sigma square the variance of each individual assets firm-specific risk divided by the number of assets. Well, this is going to be the average. Firm-specific risk. Now, what happens to the firm-specific risk in the portfolio when we actually add more and more firms? Well, that means that n, of course, increases, so 1 over n falls, right? So whatever the average firm-specific component is, let's say it's high, because we're dividing it by 1 over n, the more firms we add, the smaller the variance of the firm-specific risk in our portfolio is. So this is sort of a formal way of showing that as we add more and more assets to our portfolio, the impact of the firm-specific noise is going to get diminished, right? In other words, it's going to fall, proportional to how many assets there are in the portfolio. And that means that if we look at it graphically, if we plot the number of assets that we have in the portfolio n on the horizontal axis and the total risk in the portfolio on the vertical axis, we've actually seen this plot in the portfolio theory lecture. But now we can sort of see where formally the intuition for it, or well, the definition of it comes from. We can see that the firm-specific, or what we can call diversifiable risk in the portfolio that is relative to the number of risky assets in our portfolio n, the more assets we have, the more that drops off. But since the total risk in our portfolio is composed of the systematic and firm-specific risks, well, the systematic aspect can't actually ever go away because it's driven by how noisy that single macroeconomic factor is, let's say the market. So that isn't going to ever go away as long as the macro factor itself remains noisy and we have positive exposure to it. But what this does mean is that we can actually now mathematically show the benefits of diversification. In other words, as we add more and more risky assets to our portfolio, the firm-specific variance of all of the assets in our portfolio diminishes and can eventually become negligible.